Okay, let's unpack this. We're doing a deep dive today into a market that our sources are describing not as a panic, but as something more systematic, a broad de-risking phase.
Right. It's not one single crisis point.
Exactly. It's a convergence of things. You've got this political uncertainty that just won't go away, a sort of new fragility in our core tech infrastructure, and what looks like clearly softening consumer demand. So our mission today is to get past the headlines. We really want to extract the key nuggets that explain why risk sentiment has deteriorated pretty much across the board, US, Europe, Asia.
Yeah, why it's hitting those high beta areas so hard.
Yes, exactly.
Yeah.
Tech, crypto, and the cyclical stocks that are so sensitive to rates.
And it's so important to get the backdrop here. You have to understand the positioning is already incredibly light.
Meaning investors have already pulled back?
They've already taken risk off the table,
Nope.
and liquidity is thin. So when volume drops like this, any piece of news, good or bad, it just has this outsized amplified impact. It makes the whole thing feel so much worse.
So what are the immediate pressures?
The sources really nail three issues that are kind of feeding into each other. You've got major operational disruptions like that global Cloudflare outage.
We didn't do that.
You have weakening outlooks from key retailers, and then this renewed, very complicated political uncertainty that is specifically kneecapping crypto. Altogether, they're just stalling the market.
Okay, so let's start with that snapshot of the damage, because it's hard to ignore just how universal it was. I mean,
Yeah.
S&P 500 down 1.13%, the Nasdaq, which is so tech-heavy, dropped 1.66, even the Dow slid over 1%.
And even commodities, which you'd sometimes look to for a hedge,
Yeah.
they offered almost no protection.
Right. Crude and gold were both down. It really suggests a comprehensive flight away from risk, not just, a rotation into something else.
Exactly.
So given that scope, what are the sources telling us about the psychology here? Is this just panic, or is it more of a calculated freeze while everyone waits for a clearer signal?
It's absolutely a calculated freeze. The broad decline is driven by that classic combo you mentioned earlier, positioning, politics, and liquidity. But the immediate fuel for the freeze is this waiting game
A waiting game for what?
for two absolutely essential upcoming data sets. First up, Nvidia earnings.
Of course.
And this isn't just about one company's revenue anymore. Nvidia has become the market's main narrative anchor for the entire AI revolution, if their guidance disappoints.
The whole story falls apart.
It doesn't just hit tech, it spills over everywhere. It breaks the last really strong belief system that's holding this market up.
And the second data set.
U.S. labor data. This will be the first sort of clean look we've had at the labor market since all those shutdown issues.
And the focus will be on wages, I assume.
Completely on wage trends. If wages accelerate, that immediately reprices the Fed's rate path, and it just throws cold water on this whole mild recovery story. So yeah, these two data points are why everyone is on the sidelines.
That sets the macro stage perfectly. So let's zoom in on a sector where that narrative breakdown has been, well, particularly severe. Crypto. Bitcoin's seen a pretty significant 25% slide since October, and our sources are suggesting this is really about a fragile crypto-political narrative being exposed.
The signals are definitely there in the data.
I mean, they're palpable. ETF inflows, which everyone was hailing as this sign of institutional acceptance, they're slowing down a lot.
But the more striking number is the selling from longtime holders.
That one jumped out at me. Over $45 billion sold over the past month by the true believers. That's a massive transfer.
What's fascinating here is how the political winds have just completely changed, and it's driven by these core distribution dynamics you pointed out.
What do you mean by that?
Well, we have this expectation, you should almost call it a MAGO premium, based on certain political promises.
Okay, let's be clear what the sources mean by that.
Right. For clarity, they're defining this premium as the market pricing in expectations for, light touch regulation, some clarity on stablecoins, and even that little hint of government Bitcoin purchases.
That was the narrative that pushed prices above $100,000.
Exactly. And it is fading fast because those promises just haven't turned into actual structural legislative change. The political backdrop is becoming a clear headwind now.
And the recent elections seem to back that up.
They do. A setback like Zohran Mamdani's win in New York suggests voter priorities are shifting towards things like inflation and economic inequality. And that directly undermines the kind of populist energy that crypto is feeding on.
It sounds like that whole idea of Bitcoin as the people's money is failing, and the distribution data really just hammers that point home.
Absolutely. The sources give a statistic that is just impossible to ignore when you're talking about policy risk.
Which is?
Fewer than 10% of addresses hold over 98% of the supply. That level of concentration is, well, it's uncomfortable in an economy where wealth inequality is a dominant political theme. So as political scrutiny on that grows, the policy risk for these assets is clearly rising.
But hold on. The sources also say that despite this fading narrative, the sector has a $263 million war chest for the midterms.
It does.
Doesn't that kind of spending just buy them protection against the worst policy outcomes? How do you square that massive war chest with a fragile narrative?
That's the critical tension.
Mm.
The war chest is massive, yes, but money buys influence. It doesn't buy narrative conviction.
Oh, okay.
The money is fighting policy risk at the margins, lobbying against outright bans or crippling taxes. But the fading narrative, that's about the fundamental reason to invest in the first place. When Bitcoin loses its story as a safe haven or a political hedge, investors just stop buying it for those reasons.
So it becomes more correlated with everything else?
Precisely. Its beta goes up. That's just market speak for its sensitivity to broader risk.
Yeah.
When it can't stand on its own story, it just trades like a high-risk tech stock. And that's why that $45 billion sell-off by longtime holders is so powerful. It signals a loss of faith in the long-term, non-cyclical use case.
Okay, that shifts us perfectly from political risk to operational risk, moving from policy promises to actual physical digital failure. And the key event here was that global outage at Cloudflare.
Right.
The sources are clear. This wasn't a malicious attack, but a massive spike in unusual traffic that just overwhelmed parts of its network. It took major sites dark.
And it absolutely highlights a structural vulnerability that investors are now, I think, actively pricing in.
This wasn't a one-off.
No, not at all. The Cloudflare failure comes right after similar high-profile incidents this year at AWS, Microsoft Azure, and CrowdStrike. If we connect this to the bigger picture, it just underscores how the entire internet is now highly dependent on a very small set of providers.
For routing, for security, for cloud.
All of it. We've effectively created a digital utility, but without the mandatory redundancies you'd have in, say, the power grid. As all this enterprise traffic consolidates onto fewer platforms, that operational risk premium for cloud and cybersecurity vendors is just going up and up.
So this isn't just about a technical glitch. It's about consolidation risk. Are the sources saying investors are basically pricing this in like a utility with a single point of failure?
Precisely. They are demanding proof of resilience now. From an investment perspective, this means companies that can show they're resilient.
The ones with diversified architectures.
The ones with diversified routing, the ones that have built redundant edge capacity so one traffic spike doesn't take out the whole network. They're the ones who will gain investor confidence. The market is now rewarding operational boringness.
Reliability over pure speed.
Exactly. And the long-term cost of doing digital business globally just got more expensive because now you have to spend more on that reliability.
Let's transition now to how all this is hitting the consumer, starting with that interaction between consumers and tech. Alphabet's vertical integration strategy seems to have sent shockwaves through the online travel agencies, the OTAs.
The huge shockwave.
The sources detail Alphabet's aggressive rollout of these AI-integrated travel planning tools, and it immediately sent Booking and Expedia shares down sharply.
Because it captures the consumer so much earlier in the process.
Right. Early adoption shows people completing more of the entire journey, research, mapping, reservations, without ever leaving the Google environment. They're bypassing the OTA's traditional starting point.
This creates intense competitive pressure, and it's fundamentally about margin erosion for the OTAs. Discovery is where they made their money. If Google captures that intent early, it just diminishes the value of the middleman.
But they're not defenseless, are they?
No, and the sources tell us to moderate the panic a bit. OTAs still have strong, loyal customer bases, deep partnerships with hotels and airlines. They have a supply depth that even Google has to rely on.
So the key question is what then?
The key structural question for the future is how much of that trip planning really migrates to these AI-native environments, and how incumbents like Booking defend their value when the initial research happens somewhere else. Their focus has to shift from discovery to service and depth.
Okay, moving from digital discovery to physical retail, specifically the housing market. Home Depot's latest report gave us a really clear view of this softening
A
consumer.
very clear view.
They reported revenue upside, but the sources are quick to point out that was mostly from an acquisition, the GMS deal.
Right, that flattered the top line.
But the underlying organic demand was clearly soft and profits disappointed. And then management cut their full-year guidance.
And the reason was so specific. A stalled housing market and weaker spending on big-ticket items from consumers and contractors.
So what's the shift in behavior?
It's evident, and it's tied directly to the high cost of debt. Spending is clearly moving away from major projects, those big renovations that rely on loans or home equity, and it's moving robustly towards small-ticket maintenance.
People are patching things up instead of tearing down walls.
Exactly. Patching, not rebuilding. And the implication here is essential if you're analyzing this sector. The retailers with more diversified products and, crucially, less exposure to these big rate-sensitive renovation cycles, they're going to be better positioned. Resilience is now defined by your ability to pivot to small-ticket maintenance.
So amidst all this caution and de-risking, there is one fascinating exception that stands out, Klarna.
Yes.
They've maintained really strong momentum since their ITO, which is a real contrast to everything else we've been talking about.
The data is pretty impressive.
It is. 32% growth in active users, 23% in gross merchandise volume, and a huge 51% growth in U.S. revenue. How are they bucking this trend of consumer caution?
If we connect this to the bigger picture, Klarna's story is all about efficiency and scale through automation. Their cost discipline is striking.
How so?
Since 2022, their revenues have doubled, but their operating expenses grew by only 3%, and that's excluding stock compensation.
And why is that exclusion important?
Because it means that despite this massive growth, they've kept control over the core, fundamental costs of running the business: salaries, infrastructure, rent.
That is striking. But isn't that the core dilemma for the buy now, pay later model? If you get too tight on underwriting, do you risk sacrificing growth for that efficiency, especially when you need to show scale after an IPO?
That's a great question, and they balanced it by pointing to the engine: AI-led underwriting and automation. This efficiency isn't just from cutting marketing spend. It's from using sophisticated AI to underwrite risk instantly and automate customer service.
So that expands their operating leverage.
It does. It gives Klarna financial maturity that's really unusual in the BNPL space. It offers investors a much more resilient model compared to peers who might be just chasing pure, unconstrained volume growth.
So what does this all mean when we put all the pieces together? We've got this confluence of negative forces. Political narratives are failing in crypto, centralized digital systems are proving to be dangerously fragile, and consumer behavior is shifting away from big discretionary projects towards, well, necessary maintenance.
Or just migrating into vertically integrated AI environments like Alphabet's.
Right. So to quickly summarize the 5 key things the market is fixated on right now, we're watching Nvidia's guidance to stabilize tech.
The U.S. labor data, especially wages, to define the rate path.
Cloud infrastructure reliability as a new operational risk.
Retail elasticity from reports like Home Depot.
And finally, those sustained crypto outflows, especially from ETFs and long-term holders. These 5 items really define the immediate risk environment.
The sources show us a global economic machine that is deeply dependent on reliability, both technological reliability in the platforms we use every day and political stability in the policies that govern key sectors.
So what's the final thought for us to consider?
Well, if the consensus among sophisticated investors is that reliability risk is rising across both digital infrastructure and policy, we're left with a really fundamental question. What does that rising premium for reliability mean for the long-term cost of doing digital business globally? That structural shift, I think, will define who wins and who loses in the coming cycle.